Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Today, we are taking a deep dive into what is honestly a massive financial contradiction.
Yeah, contradiction is definitely the right word for it.
Right, because, the Federal Reserve has finally stopped raising interest rates, so naturally, you would think your mortgage should be getting cheaper, but well, the exact opposite is happening. According to recent analysis, mortgage rates just hit a one-year high.
It completely defies conventional logic. I mean, we are really moving out of this era where central banks dictated everything, and we're entering a new landscape where the open market is, well, it's aggressively taking control of your borrowing costs.
Yeah, and that's why we're unpacking this concept today. It's called a hawkish freeze. We're going to look at why the world's biggest central banks are pausing their rate cuts, why long-term borrowing costs for you, the everyday investor, are actually climbing despite this pause, and how to protect your portfolio in a world where the cost of money has permanently shifted.
It's a fundamental shift, absolutely.
So let's start right at home. When you look at the U.S. Federal Reserve's most recent decision, on the surface, it looks like a simple pause. The data indicates that on July 29, 2026, the Fed kept its benchmark interest rate steady. They held it at a range of 3.50% to 3.75%.
Yeah, and on paper, sure, it is a pause. But if you look at the underlying mechanics of that meeting, it paints a much more chaotic picture.
Chaotic how? Because looking at the breakdown of the vote, this wasn't unanimous, right?
Not at all. Out of the 12 voting members on the committee, 3 of them actually demanded a 25 basis point hike.
Wait, a 0.25% increase right then and there.
Exactly, right then and there. And we really need to emphasize how unusual that is for the Fed.
I mean, they usually agree on these things, right?
Yeah, they prize unity. They always want to project absolute certainty to the market. So when the new Fed chair, Kevin Warsh, is dealing with a level of internal division that hasn't been seen in that room since, what, 1970?
Wow, 1970.
Yeah, it signals intense underlying stress about the direction of the U.S. economy. 3 dissenting votes demanding a hike out of the gate is a huge red flag.
Which really makes me wonder what is causing that internal panic. I mean, when you dig into the recent economic analysis, you see that inflation has been stubbornly above the Fed's 2% target for over 5 years now.
5 long years, yeah. And it's clearly not just one isolated issue anymore.
Right. It's like a perfect storm of structural forces. We've got lingering energy shocks. And under the current Trump administration, there is a heavy focus on tariffs, which inherently raises the cost of imported goods.
Absolutely. Trade policy is playing a big role. Plus, you have massive government fiscal deficits that just keep pumping money into the system.
And we can't forget the artificial intelligence boom. I mean, building these colossal data centers requires unimaginable amounts of energy, copper, cooling system.
Oh, the infrastructure costs are astronomical.
Yeah.
And all of those disparate factors pool together to create this relentless upward pressure on prices.
So the Fed is looking at this cauldron of trade policy, tech shifts, government spending.
And they're realizing the forces driving prices up are just way too strong to declare victory.
Which brings us back to this idea of a hawkish freeze. Because of all those pressures, current data indicates markets are pricing in a 67% chance of a rate hike in September.
Yeah, almost a 70% chance they hike next month.
So they paused in July, but they're holding this threat of a hike over the market. It really makes me think of, driving a car.
Okay, how's that?
Well, this isn't taking your foot off the gas to let the car coast. It's hovering your foot aggressively over the brake pedal. You aren't pressing it down just yet, but everyone in the car is sweating because they know you might slam on it at any second.
That is a great way to put it. And to take that driving analogy a step further, by hovering over the brake, they are essentially buying time.
Buying time for what?
To look at the next batch of economic data without actually committing to a cut. They are telling the financial system, we aren't lowering rates, and if inflation ticks up even a fraction of a percent, we will slam that brake and hike again.
Well, wait, if they technically pause the short-term rate, why is my mortgage going up? I mean, that makes no logical sense. If the Fed hit pause, why are things getting more expensive for everyday people?
Because there is a severe disconnect happening in the economy right now. There's this massive gap between the Fed's short-term policy, that 3.50% to 3.75% rate, and the long-term rates that dictate our major life purchases.
How does that gap actually work in practice, though?
Well, historically, central banks rely on something called forward guidance.
Which is like a roadmap for the market.
Exactly. They would give the market a clear, predictable roadmap, essentially saying, hey, We plan to hold rates here for 12 months and then slowly cut.
Giving everyone a heads up.
Right. But Chair Warsh has decisively moved away from forward guidance.
Hmm.
He prefers to let the rolling economic data dictate the path, meeting by meeting.
And the market absolutely despises uncertainty.
It hates it. When investors don't know the flight path, the bond market stages a rebellion.
A rebellion.
Yeah, investors are looking around, they're seeing government deficits, tariffs pushing prices up, and they're saying, well, if the Fed won't give us certainty on inflation, we are going to demand a much higher return to lend our money out for the next decade.
And according to recent analysis, that demand is why the 30-year U.S. Treasury yield jumped past 5.2%.
Which is huge.
Just for context for you listening, the 30-year Treasury hitting 5.2% is a 19-year high. It's kind of like the captain of an airplane refusing to turn on the seatbelt sign or announce the flight path over the intercom.
Oh, I like that.
Yeah, the passengers look out the window, they see these massive storm clouds, and they just strap themselves in anyway.
Right.
They're bracing for severe turbulence even without the captain's warning.
They are bracing for impact. And in the bond market, bracing for impact literally means demanding a higher yield to compensate for the risk of that turbulence.
Which mathematically drives the yield up to that 5.2%.
Exactly. And because the 30-year Treasury yield is the foundation for almost all other long-term loans, the 30-year fixed mortgage rate shot up right along with it, hitting 6.66% at the end of July.
Wait, so the Fed doesn't actually control all the interest rates. The market can just rebel and raise my mortgage rate on its own.
Precisely. The Federal Reserve only directly controls the overnight borrowing rate for banks. That's it.
Wow.
Yeah, the real drivers of the everyday U.S. economy right now aren't just the Fed funds rate. It's inflation expectations and fiscal deficits. The cost of long-term capital is structurally resetting higher, completely independent of the Fed's July pause.
And because the U.S. bond market is forcing American rates so high, it's acting like a giant vacuum for global capital.
Massive vacuum, yeah.
Okay. That vacuum is sucking money into the United States, which, well, it forces foreign central banks into a really tight corner. Let's look at how this ripple effect is playing out globally.
It's definitely a global issue now.
Right. Starting with Europe, recent analysis shows the European Central Bank also did a hawkish pause at 2.25%. But they are dealing with a severe stagflation trap.
Stagflation is pretty much the absolute worst-case scenario for any economy.
Break that down for us. What does stagflation actually mean?
It means economic growth is stagnant, but inflation is high. Europe's real GDP actually shrank slightly in early 2026, but their inflation is still nearing 3%, which is heavily driven by energy costs.
So what does that actually look like on the ground, say, for a business in a European country?
Well, imagine a massive manufacturing plant in Germany. Their energy costs have doubled, right?
Yeah.
So they have to raise the prices of their goods just to survive.
Okay, so that's the inflation part.
Right. But because the broader economy is weak, consumers aren't buying those expensive goods. That's the stagnation. Yeah. And if the European Central Bank raises interest rates to fight that inflation, they make borrowing even more expensive for that struggling factory, which could drive it into bankruptcy.
But if they don't raise rates,
Then the cost of living just keeps crushing the everyday consumer. They're completely paralyzed.
that is a brutal lose-lose situation. And then looking at Australia, the data shows their Reserve Bank paused at 4.35%. But their housing market reacts very differently to rate hikes than ours does here in the U.S., right?
Very differently. Australia is a vital leading indicator for the global consumer because of how their mortgages are structured.
How so?
Well, in the U.S., you lock in a 30-year fixed mortgage. If rates go up, your monthly payment stays exactly the same.
You're shielded from it.
Exactly. But in Australia, the vast majority of mortgages are variable rate.
So when the central bank hikes, the homeowner feels it instantly.
Within weeks. A middle-class family in Sydney suddenly has to pay hundreds of dollars more every single month for the exact same house.
That's devastating for a household budget.
It is. And Australia had already aggressively hiked rates earlier in the year, before this recent pause. When you drain that much disposable income from households that quickly, consumer spending across the rest of the economy starts to crack.
Because all their money is going to the mortgage.
Right. And if the Australian consumer breaks under the pressure of these variable rates, it is a massive warning sign for the rest of the developed world.
But as concerning as Europe and Australia are, the data indicates the most dangerous wild card in the global economy right now is actually Japan.
Oh, without a doubt, Japan is the wild card.
The Bank of Japan recently kept their policy rate at just 1.0%, and you compare that to the US at around 3.6%, that is a massive gap.
A huge spread.
And capital naturally flows to where it can get the best return, right? Which means an ocean of money is flowing out of Japan and into the United States, causing the Japanese yen to weaken dramatically against the US dollar.
And that weakness of the yen really forced Tokyo's hand. The US and Japan reportedly intervened in the currency markets together.
How much did they spend?
An estimated $59 billion just to prop up the yen and stop it from crashing.
$59 billion. And that intervention directly threatens something called the yen carry trade.
Yes, it does.
I really want to walk through this because it connects esoteric global finance directly to an everyday American's stock portfolio. So let me see if I get this. The carry trade, it's like borrowing a huge sum of money from a friend who only charges you 1% interest. And in this case, that friend is Japan.
Right, cheap money.
So you take that borrowed cash, you buy U.S. investments paying 4% or higher, and you just sit back and pocket the difference. It feels like free money.
It does feel like free money as long as the currency stays stable.
Right. But what happens if the exchange rate violently flips? I'm a bit lost on how a currency shift in Tokyo actually tanks my 401k here in the U.S.
It basically comes down to forced liquidations.
Yeah.
There are literally trillions of dollars tied up in this trade.
Trillions.
Trillions. Massive hedge funds and institutional investors borrow cheap yen to buy U.S. tech stocks and treasury bonds.
Oh.
But they are using heavy leverage. So if Japan intervenes and the value of the yen suddenly spikes, the cost of that original loan skyrockets.
Basically, the friend just called in the loan and demanded their money back.
Exactly. The banks issue a margin call. They demand more collateral immediately. And to get that cash, those global investors have to suddenly and violently sell off their most liquid assets,
Which are?
their U.S. stocks and U.S. bonds.
Oh, wow. So a currency adjustment in Japan triggers an actual flash crash in the American stock market because everyone is rushing for the exit at the exact same time to pay back their yen debts.
Exactly. It creates a highly precarious feedback loop. You know, the U.S. bond market rebels, which keeps U.S. rates high. That yield gap weakens the yen. The weak yen forces Japan to intervene.
And that intervention threatens the carry trade.
Right, which then threatens to trigger massive forced selling in U.S. equities.
Okay, so we have a global rate freeze, we have rebellious bond markets driving up mortgage rates totally independently of the Fed, and we have the lingering threat of a Japanese currency crash triggering a stock sell-off.
It's a lot to take in.
It is. So what does a regular investor actually do with this data? How do you protect yourself?
Well, first, it requires acknowledging a fundamental regime change. For the last 15 years, we lived in a zero interest rate world. Capital was essentially free.
Right. Borrowing was cheap.
But that era is over.
Yeah.
The cost of money is now structurally permanently higher, and your portfolio strategy absolutely has to adapt to that math.
So let's start with bonds. The traditional advice is always that bonds are the safe haven, right? But lately, recent analysis warns that bonds are risky. What is the actual mechanism at play there?
The risk entirely depends on the timeline of the bond, specifically due to something called duration risk.
Duration risk.
Yeah. So say you buy a 30-year treasury bond paying 3%, right? And a year later, because of inflation, new bonds are issued paying 5%. Well, nobody wants your 3% bond anymore.
Right, because why would they take 3% when they can get 5%? So to sell it on the open market, you'd have to slash the price of your bond.
Exactly. That mathematical drop in the bond's resale value is duration risk. The longer you are locked in, the harder your bond's price drops when new rates rise.
So long-term bonds are highly volatile right now.
Very dangerous, yeah. However, short-term government bonds, like 3-month or 6-month treasury bills, are an incredibly strong defensive play right now.
Because they mature so fast.
Right. You are locking in a 4% or 5% annualized yield, and because the duration is so short, you have almost zero risk of rising rates crushing your principal.
Okay, that makes sense. Keep bond duration short. What are the stock market? A structurally higher cost of capital has to completely change the math for corporate America.
Oh, it creates stark winners and losers based on a concept called the hurdle rate.
What's the hurdle rate?
It's the minimum return a company needs to make on a project to justify the cost of the borrowed money.
Okay, give me an example.
Let's look at big tech. They are pouring tens of billions of dollars into AI data centers. Now, in a world where borrowing costs 0%, the hurdle rate is low, right? You can experiment, you can wait years for a profit.
Because the debt is free.
Exactly. But when the cost of capital is 5% or 6%, that $10 billion data center has to generate massive immediate profits just to break even on the debt.
So the hurdle to jump over is significantly higher. It honestly sounds like investing in a drought.
A drought.
Yeah, think about it. The plants that need constant watering, the companies that rely on endless, cheap debt to survive and fund unprofitable growth, they're going to wither.
Oh, that's a brilliant analogy. And to take that drought analogy a step further, the companies with deep roots are the ones with strong free cash flow and pricing power.
Meaning they don't need to borrow money to survive, and if their own costs go up, they can just pass those costs on to the consumer without losing business.
Exactly. Think of sectors like energy defense contractors or critical infrastructure.
Right.
If an energy company's costs rise, they just charge more because you still have to heat your home and put gas in your car. They have a built-in moat against inflation.
So companies with pricing power thrive in a high-rate environment.
Yes, while heavily indebted companies face a brutal reckoning.
So does this mean the era of blindly buying broad index funds is over? If a rising tide lifts all boats, high interest rates seem like the tide going out.
You certainly have to look much closer at what you actually own. In a broad index fund, yes, you are buying the highly profitable cash-flowing companies, but you are also buying the highly indebted zombie companies that only survived because debt was free.
So the margin for error is just much thinner now.
Much thinner. You want exposure to companies that don't need to beg the bank for money just to operate.
That makes a lot of sense. So let's recap the landscape we've covered today. The summer 2026 pause by global central banks is definitely not a victory lap.
Far from it.
It is a tense holding pattern. Whether it's the Fed in the US, the ECB in Europe, or the BOJ in Japan, central bankers are hovering their foot over the brake pedal.
Ready to slam it.
Right. Meanwhile, long-term borrowing costs are fundamentally shifting upward because the bond market is demanding higher returns to offset inflation and government deficits. The hurdle to make money in stocks, in real estate, or in running a business is permanently higher than it has been in years.
In the interconnected nature of this global economy, from U.S. fiscal policy to Australian variable mortgages to Japanese currency interventions, it means everyday investors have to be incredibly vigilant.
You can't just ignore it.
No, the old playbook of just setting it and forgetting it in a zero-interest world simply doesn't apply to this new math.
Which leaves you with one final, lingering question to mull over as you review your own investments. For decades, central banks used forward guidance to dictate exactly where the economy was going. They were viewed as the undisputed masters of the financial universe.
They really were.
But if the bond market is now rebelling and setting its own mortgage rates, and if global currency trades are forcing sudden market sell-offs completely independent of the Fed, who is really in control of the global economy right now, the central bankers in their boardrooms, or the chaotic, uncontrollable open market itself, don't forget to subscribe and hit that like button.